In the U.S., oil prices fell 2%. The cost of light sweet crude dipped below $60 a barrel for the first time since 2009. Joining me now is Chad Brownstein. He is the CEO of Rocky Mountain Resources. And Chad, we have you now. Thank you so much for being with us. Talk to me about what is driving this sell-off in oil. It is so rapid. Is it based on fundamentals? And how low is it going to go?
Well, it's certainly Black Friday for large cap oil stocks. You want to be grabbing as many as you can at this moment. We had a gap down to 75, which was driven by fundamentals where OPEC drove that. But the gap down from 75 now to 60, soon to be maybe mid 40s, is a function of CLOs having to liquidate. You're seeing large cap debt infrastructure trading down in the 70s and 80s, and that's forcing a global sell-off on the debt side. So investors can't price risk right now. There's 18 times leverage in the market for every barrel of oil. To put that into context, in 1997 there was 3 times. In 2007 there was 13 times before the value of oil went down to the mid-40s. So we have a long way to go. It's not a function of supply and demand. It's a function of technical sales, because the $550 billion worth of debt that's been sold in the market is all being bought by these structured vehicles, which are now having to sell because the senior debt's trading below 90.
Okay, so when you say, just so we understand this, because it sounded a little bit technical for those who don't follow the market, when you're talking about CLOs, are we talking about hedge funds, basically hedge funds that bought up this sort of high yield, maybe junk debt that was issued by all of these producers who were levering up, borrowing heavily so they could invest in production and in facilities? Is that what you're telling us?
Rather than hedge funds, let's say structured funds, which can be managed by private equity firms, by hedge funds, by independent asset managers. And they have structures where they have layers of debt. And when a piece of debt that they own gets below a certain price, they're forced to sell by the mandate. So what you're seeing right now is a global repricing based on $75 stock, which is further accelerating the sale of oil down to the mid-50s. So we're not talking about a supply and demand issue. 93 million barrels are going to get bought next year. The U.S. is going to have production. OPEC's going to have their production. We're talking about a global sell-off of the fixed income side, which is going to benefit the value for the OPEC buyers, because they're going to be able to hurt mostly the offshore drillers in the United States, because that's $50 a finding barrel. You can't produce when you're at those prices.
Chad, that's exactly what I wanted to ask you. Everyone's talking about where that pain threshold is, where you're going to start to see U.S. producers, if not go out of business, at least close down production, take some production off the market. Do you see a lot of businesses failing as a result of this? What is going to happen to U.S. production?
I see U.S. production staying at the 9 million barrel number next year. Now let's talk about that relative. It's up 50% in the last 3 years. Extraordinary growth. It's got to slow down at some point. And when you're talking about the offshore drillers, the large cap players have $50 finding costs versus the domestic onshore, even the shale players have $15 to $20 finding. You're going to see the shale players in the good areas survive. You're going to see deep offshore get shut in, because at $50 a finding barrel for the foreseeable future, when you have a forward curve in the 50s, you can't produce. So that's who's going to get hurt, the larger players. And then the tertiary markets, with regard to ultimately the shale plays, will also get hurt equally to that.
It's fascinating what's going on. Chad, thank you so much for walking us through it. It is quite technical. It's important that we understand it. And again, we're going to continue to debate. Difficult for producers, difficult for countries, but no doubt a good thing for U.S. consumers who are filling up their tanks right now.